Good evening, August 14, 2014. My name is Fausto Botelho. I am from São Paulo, Brazil. I'm 61 and I've been around following the markets with my charts for over 36 years. Today the market gives us one of the big indications. And whenever that happens, I feel like sharing. And that's precisely what I'm doing now. I used to publish an analysis with lots of charts written, but fortunately I'm not old enough to be able to use all the technology available today, so I am producing this video, which later I'm going to upload on YouTube, and I'm also going to tweet it. You can follow me on Twitter at Fausto Botelho. That's FAUSTO-BOTELHO, it's written below. Very well. The indication of today was that oil prices should drop 50%, even more. Why is that? Well, I'm first going to show you the indication here in my chart. In my candle chart, the indication was the fact that the market broke this support line, this line which is called a support line. But to understand the importance of this indication, I invite you to come with me with my helicopter, leave the trees and take a look in the forest. For that I'm going to zoom out my chart, and then I have to transform my candle chart into a line chart, because from 2003 only we start to have open, high, low, close. Before that we had only close, which can't be seen in this chart unless I transform it into a line chart. So I present you with a 30-year-old chart of oil prices, of specifically West Texas Intermediate oil prices traded in the Chicago Mercantile Exchange. We can easily see that as a commodity, oil prices traded in a range. For 20 long years, oil prices traded in this range between the blue line, which we call a support line, and the red line, which we call a resistance line. But I'm going to call this as a cave. Oil prices inhabited this cave for 20 years. Then in 2004, they broke this cave. They left home. They went to unknown territory. And that was because of the credit bubble that started in 2004, lasted until 2008, as we well know, made the oil prices skyrocket to $145 a barrel. Now I'm bringing my chart back to candle and want to show you that the oil prices just collapsed, but they bounced on the top of their cave and went up again. In the beginning, with the same inclination, but they came down, producing what we call a V button, and then they started these barely upwards trend that coincides with the period of the quantitative easiness. Very well. This is a kind of accumulation, a sort of accumulation that we technical analysts know very well, and it's called head and shoulders. That's because we have a top which is called the head, and then we have whatever may be called as a left shoulder and what may be called as a right shoulder. But that's not important. The name is not important. What is important is that the market respected this support line for 5 long years, and it touched this line for almost 2 here technically. It's a point in the line. 3, 4, 5 times as well. Last week it touched it for the last time, and it then today broke the line. When that happens, we empirically know that we can easily expect that the market produces a downward trend that goes to the objective that is projected from this sort of accumulation, which is the range between the head until the neckline projected from the broken part over here. And that brings us to $43 a barrel, which from today's price it's equivalent of a 55% drop. Now what's interesting is that the projection that we can make out of this head and shoulder formation, it's the exact range of the first big drop of the subprime crisis. Then the market went up, as it usually do. The market went up, producing a reaction to this bear market of 20.4% in only 1, 2, 3, 4, 5 days, which we can expect to happen in the near future. But now with the growth of this line, I'm expecting the market to drop fast to $65 a barrel. Then we can expect some reaction of a size comparable to what happened in the last time the market fell. Now the question is, how long will it take for it to happen? Well, I don't know. What I know is that this is a very important line, and below this line there should be millions of stop orders. People will start reverting their long positions. Stop orders are going to be touched. Hedge funds will have to liquidate oil positions, and that can happen very fast. What we do know is that last time that the market had a drop of these proportions, it took 1, 2, 3, 4, 5 months for the market to drop from top to bottom 77%. Now 50%, it could be in months maybe, depending on what's going to happen with the Dow Jones. By the way, I have just issued another analysis, another video. You can find it in our in my Twitter, of course, but also in our channel in YouTube, which is youtube.com/constop. Constop's written below here. So this is it. I wanted to share these big indications that oil prices should drop 50% from now on. Thanks for watching. Until the next big technical analysis indication.